on US non-farm payrolls day. So the strategy basically is a trap strategy, which is predicated on the market making a big move after a piece of news, and then people finding out that they've got the move wrong, the market wrong, and then seeing a retracement, and then the market goes back in the opposite direction, and that provides a trading opportunity for those who are looking to trade the trap strategy. So let's start the thing off here. So first things first, what are market traps? Well, the theory is that many of the big moves in the markets that occur tend to follow a false breakout of some kind. And I call these setups market traps. Now, traps are formed when traders are caught on the wrong side of the market. They typically form after a technical move, i.e. a break of a chart support or resistance level, but often they've got a fundamental trigger, i.e. a piece of news. So how do market traps form? Well, I've got a two-step kind of acronym for it, a break and retrace. So the break occurs when the market makes a significant move due to a break of a support or resistance level or a piece of news. And significant involves markets taking out all the stops, and panic buying or selling comes in as people react to the new reality. But if that break move is reversed, then a trap has formed. And then we've got ourselves a really good trading setup for the rest of the session, or maybe the next few sessions. So break and retrace, watch this space. So this is the graphical representation of how the trap forms. So a piece of news, for example, in a news trap comes in. This is the event. Then the market has a sudden knee-jerk reaction, in this case to the downside. This is the buy setup. And if the move doesn't see follow through, momentum to the downside, we get people who sold based on the news start to cover their short positions. And as they do this, they start to realize that perhaps they're underwater a little bit on their positions. And before you know it, we get to a critical mass as we approach the origin point. In other words, the point at which the piece of news came out, the buy trigger is for the setup here. And once we get to that point, all of the sellers, they know that they're wrong, and they have to cover their positions. And before you know it, we see quite a good short squeeze kicking off. Now, as I say, the move can last for the rest of the session, or it can last for several sessions. It depends sometimes on how significant the move was to the downside for a buy setup. So the news traps, how do they form? So a piece of news comes in and it surprises the market, and it often produces a very sharp movement. So the news influence traders, the fundamental traders, they come in and they react to this new reality by selling the market. And that is the break part of the break and retrace setup. So as I say, if the news related break fails to see significant follow through to the downside, then those who sold the break, for a short example, will start to cover their positions. And before you know it, we start to see the retrace. On the buy side, if the piece of news is bullish, the market shoots up. And if we don't see significant follow through to the upside, people who bought the market, they start to exit losing long positions. And before you know it, we've had the break and the retrace, and then we've got a sell set up. So as I say, once the break move has been retraced, then the trap has formed, the trap is ready, and then we can start to see a big move in the opposite direction to the break. So when talking about news traps, it's good to break down news events into different categories. There are two categories, in my opinion. There are two categories, one being scheduled news and the other one being unscheduled news. Now, scheduled news is basically news that we know about in the future, stuff that you can see on an economic calendar. For example, US non-farm payrolls, which are going to come out a bit later on, interest rate decisions, meetings, economic numbers, for example, retail sales figures, consumer price index, GDP, confidence numbers, a whole range of numbers that we know about in advance. There's a market expectation that develops in the weeks leading up to the release of the number. So lots of people, they go around Bloomberg, Reuters, a lot of people, they go around the markets, they talk to the main analysts, and they say, what do you think about US non-farm payrolls that's coming out in a week's time? And they give their forecast. And over the course of a week, 2 weeks, a consensus develops for the forecast. And the big players, they start to take trading positions based upon the forecasts of their economists. So we can see that the market in the run-up to something like the US non-farm payroll develops a bit of a bias going into the number in terms of market positioning. So when the number comes out, and if for some reason the number is widely different from the expectation, the market consensus, then we've got a situation where the participants will have to readjust their positions to accommodate for the new reality. And that's when we start to see these sharp movements due to news, which can set up this news trap trading strategy. The unscheduled pieces of news, obviously, are things that come out of the blue. For example, off-the-cuff announcements by leading political figures or monetary officials, any currency intervention, we don't know about that in advance, any political pieces of news that just hit the news wire, and we start to see sharp movements as people react to them. So we've got a slew of potential trading setups across various markets coming from various different countries that if you want to be just a news trader, this can be quite a good methodology because it gives you a lot of potential setups. So scheduled news and unscheduled news. So this is the just a picture of the economic calendar, just to show you what, if you're a news trader, this is what you'll be using as one of your tools. This is the CFI one. You can see that on most economic calendars, there is a previous number, that's what came out the last time, the market forecast, the consensus for the number, and then when the number comes through, it goes into the actual column. And that's when you see the sharp movement in the markets as they react to a difference in the actual number and the forecasted number. Okay, so now let's take a look at a few examples of the news trap strategy in action. So the first one, US dollar and non-farm payrolls. These are a few old examples going way back, but I'll show you a few more recent ones as we go along. So this one, just prior to the news, euro dollar was trading at a price of 145.5. The news came out. The euro dollar fell sharply as the dollar was bought on a stronger than expected number, but within the hour, euro dollar retraced very sharply and came all the way back up to the news origin. So this is the kind of break and retrace action that I'm talking about. So the market is trading here just before the news. The news hits the wires. There's a knee-jerk reaction to sell euro dollar in this case. So people are selling this market as the new reality hits. But the people that were selling it down here, as the market starts to move up, they start to be losing money. And particularly if they're kind of weaker players, they'll be wanting to cover their losing short positions. And maybe if they're kind of sitting in a bank and they've got a head trader standing over their shoulder saying, what is your position? And it's going the wrong way, they might start to panic a little bit. And before you know it, we start to see a bit of a short squeeze. So once we get up to this news origin price, 145.5, all of the people who sold euro dollar on the back of this stronger than expected US non-farm payroll number are now losing money. And that sets up the conditions for a very powerful short squeeze. So in this case, let me just show you what happened afterwards. So there we go. So basically euro dollar, it broke through the trigger, the news origin trigger there. And for the rest of the session, or for much of the rest of the session, we saw a good rally in euro dollar as short positions, people who are short and losing money, cover their positions. And before you know it, there's a bid under the market and euro dollar rallies quite sharply. So that's the basic premise. Let's see a few more examples. Okay, another one from way back. This is cable, sterling dollar, and UK retail sales. Just prior to the number in this example, cable was trading at 149.40 to 45 or so. The number came in, it was a much stronger than expected UK retail sales number. And the knee-jerk reaction here was to buy cable, to buy sterling, sell the US dollar. So you can see that cable shot up in this instance above the psychologically important 150 level at the time. But pretty quickly afterwards, the move was retraced. So we had this break, and then we had a pretty steep retrace, but it didn't really do much beyond the trigger there. Then a bit more buying came in, and then over the next couple of hours, the market went through the news origin price, and that trapped all of the buyers above the news origin price. So as before, the people who bought after the piece of news on the piece of news, they are now trapped because there can be nobody who is long this market after the news making money. So this sets up a nice little positioning squeeze to the downside. So what happened in this case, you can see that cable sold off for the rest of the session. So we had the break here, just looking back on the trade. So we had the break on the news, market comes back, a little bit of secondary buying coming in here, but they couldn't take it to a new high. Then the market goes back through the news origin there, and that traps all of the buyers. And then we've got a trading setup here where you could sell the market and looking for moves down into the rest of the session, and maybe even for sessions afterwards. Next example, dollar Canada and Canadian retail sales. Similar kind of thing here. Dollar CAD was trading at 101.60.65 prior to the news. The news came out, it was a very strong number. Canadian retail sales are very strong, and the knee-jerk reaction was to buy the Canadian dollar, sell the US dollar. You can see, in fact, there was a big gap on the news, then a bit more selling here. So all of these people here were selling this market based on the news. But as with the previous examples, we had the retrace move, not too long afterwards. And before you know it, we were back at the news origin price. So all of the sellers on or after the news are now losing money. And that's the key point with this news trap trading strategy, is to look for a situation where the market has shown its hand and is ready to go most likely one way rather than the other way. So rather than anticipate whether there's going to be a trap or not, it's better to wait for the trap to form, in my opinion. Okay, so in this case, dollar CAD found itself back up at the news origin. And then the market went sideways into the close and then early into the next session. And then sessions afterwards, next few sessions afterwards, a little uptrend began. And you could see that the dips were supported at or around the news origin price. So you can see the typical technical analysis type thing where resistance becomes support. We have that kind of flipping over there, reversing of roles. And as the market pulls back, those who are short the market, they're getting out of this market any chance they can get as it comes back towards their entry price for short positions. And as I say, we start to see a bit of an uptrend develop in dollar CAD. Okay, here's another perhaps more extreme example. This is the UK general election result back in December. And as we know, sterling reacted very strongly to the upside on the crushing Conservative election victory. That kind of set the record straight and made everything look so clear for Brexit and all of the other economic factors. The fact that we had a clear winner and no hung parliament, and basically the uncertainty was taken out of the market, which is what markets like. So just prior to the exit polls and the results coming through, cable trading at 131.75. We got this big gap up here to 34.5 thereabouts, traded briefly above 135, and then the market sort of sold off, bit of profit taking going into the close. Then next session, the market starts to rally a little bit, but don't forget we still have this news origin trigger down here at 131.75. So what happened over the next few sessions? These are session breaks, by the way. These dotted vertical lines here on the chart. So over the next few sessions, cable started to sell off, and then before you knew it, we were back to the origin price, 131.75, and that trapped all of the buyers based on the UK election results. So we had a trading setup for a multi-day time frame. So once it hit the trigger here, the market starts to trend lower for the next several sessions. So it gives you a good idea about which way the market is positioned and is likely to go. Okay, another example, US non-farm payrolls. This is one where we were at 131.75 on euro dollar this time, just prior to the non-farm payroll release. In this case, US non-farm payroll fell twice as much as the market had expected, and the dollar plunged. It's funny how the economists can get these numbers so wrong, but it does happen from time to time. So euro dollar saw a massive knee-jerk reaction to the upside. So 131.75, it shot up a big figure pretty much within the hour, and then saw a bit of follow-through buying, and then into the close. It's a relatively strong close, although a little bit off of the highs for the session. So post non-farm payroll, people who had bought euro dollar sold the US dollar on the back of this weaker than expected number. For the most part, were sitting pretty going into the weekend. But what happened, a little bit as with the cable example on the election, so what happened was the next session, the market trended lower. Session afterwards, we broke through the origin point. So that closed the trapdoor on the buyers based on the US non-farm payroll figure here. And that set the stage for quite a good decline in euro dollar, a rally for the US dollar over the next several sessions. So you can see in all these examples how the piece of news generates a big movement up or down depending on how the news comes out with regards to the expectation, and it shows the market has made a bet. And once the market has shown its hand, it's a bit like, I guess, if you're playing poker and somebody shows you perhaps one or two of their cards. Once you know which way the market is likely to go, and you've got a little sort of chink in the armor of the enemy, if you will, then we can see which way we should make a bet. And in this case, once we come back to the news origin trigger, we've got ourselves a setup which can last either for the rest of the session if you're a day trader, or maybe multi-session if you're a multi-day swing trader. Okay, a bit more recent examples now. This is the 4th of January 2019. This is the payroll number for December 2018. In this case, I'm just giving you a few numbers here. So the expectation for the number was a rise in 176,000 non-farm jobs. And the number came out at plus 312,000, so much better than expected. So you can see that, as in the previous examples, when the number is better than expected, euro dollar generally declines pretty sharply as the dollar rises. In this case, we saw this big kind of spike lower, quite a good move down, bit of a bounce up, and then some more selling in towards the latter stages of the European session. Okay, so most of the traders in that liquid time zone of early US and late Europe, they are short euro dollar. Okay, so a lot of people are, the market has positioned itself to the downside based upon this new fundamental reality. But what happens by the end of the session, the market has seen quite a sharp move back up from the low of 113.45 back through that news origin point of 114.03. So that has sprung that trap for the bears for the euro dollar shorts. So basically, again, anybody who is short below this red line is not feeling too happy at or towards the end of this Friday, this session. So into the Monday, the market starts to rally slowly. And before you know it, we have a nice uptrend for the rest of Monday. So you can see that the trapped sellers of euro dollar from Friday, they are bailing out of their short positions into the Monday. Euro dollar is supported on dips. And it gives you a good idea as to which way the market should be headed once that trap has sprung. Now, what I've put on this chart here in green, you can see I've got ATR 20. Now, this is the average true range, the 20-day average true range for euro dollar. And I use this as a bit of a gauge to give me an idea just how significant a move can be or has been. I like to see a market move 50% of the ATR from the origin point to say, yep, we've had enough participation in this market to suggest that the market has kind of shown its hand. I think much below 50% ATR then maybe the move isn't that significant, but a lot of other factors could come into play there. So a 50% ATR move from the origin point for me is a significant movement. So in this case, what we got was euro dollar declining 68.2% ATR, so slightly above the minimum requirement. So that's enough impact for me to say, okay, should we get back to the origin point, then we've got ourselves a nice setup. And as we go into the Monday, we can see it's a nice trade to the long side. Okay, this is non-farm payrolls on the 6th of December, a bit closer to where we are now. The number, again, it was plus 187, and the market came in at plus 266. So again, we saw a stronger than expected payroll number. Seems to be a lot of these numbers that come out stronger than expected, but there you go. So just prior to the number, euro dollar was trading just below 111. There's the knee-jerk reaction as the number came in stronger than expected, as people buy the dollar, the knee-jerk reaction to sell the euro and to buy the dollar. Bit of a bounce back, and then the trend for the day starts to kick off down there, and pretty much a weak end of Europe into the US session close. But this one actually developed over the next few days, a bit like the cable example for the election and the extreme example for the non-farm payroll. This one developed over the next couple of sessions, Monday to Tuesday. Tuesday retested the trigger, and then on the Wednesday we broke through with quite extreme violence here. So that gave the trigger for the post non-farm payroll sellers that that trade is done. So the market rallied quite sharply, supported on dips above the old origin point, and you can see it's quite a good piece of upside for euro dollar over the next few sessions. In this case, the move was quite significant because it fell 37.7. It fell 148% of ATR. The ATR back in 2019 was actually quite low because volatility in 2019 was down at historic low levels. So the ATR for euro dollar was at this time 38 pips. So the move did have very significant impact at the time in terms of the average true range. So when the market broke through the origin point, we saw quite a violent move to the upside. Okay, this is a very recent example. This is the ECB meeting, not yesterday's one, but the one the previous month, 30th of April 2020. The ECB meeting on the interest rate announcement, 145 CET. Euro dollar was trading at 108.84. That was the news origin. Then it started to break down, and then a bit of selling going into the as the conference was getting underway. So post ECB, the news event was basically the ECB rate announcement and the policy meeting. So euro dollar was selling off. So everybody was basically selling the euro based upon the news coming out of Frankfurt. But shortly afterwards, we saw euro dollar go back through the news origin price. And again, that sprung the trap for the sellers of euro dollar. So that gave you a nice buy signal or a buy indication that euro dollar, those who had sold based on the ECB, all of the news that was coming out of the ECB conference, anyone who sold that market, once you'd gone through this news origin point, you're now underwater, you're losing money. There's only one way this market should be heading in theory. So this one was pretty much instant gratification for the bulls. We saw pretty quickly how the market ramped up it ramped up just shy 109.80 or so, bit of selling into the close, and then the market closed quite firm. So the fundamental sellers of euro dollar, based on the news coming out of the ECB, by the close, they were not feeling too happy. Into the next trading session, bit of sideways, and then a new trend to the upside started. Then we broke above the psychological 110. So from the news origin point here down in the low 108.80s up to 110, not a bad trading opportunity for buyers. Okay, so that's a range of examples for the news trap trading strategy. So let me just show you how I like to apply the news trap trading strategy. This is the buy setup. So check the economic calendar for news releases. Those which are significant, many of them are marked in red, or there is some indication on the economic calendar for the ones which generally will have a should be having a good impact on the market. So just before the news comes out, it's good to note the price of the market that you are looking to trade. In fact, what you can do is there may be a number of markets that you could trade should you get impact, and note down the price of those markets just prior to the release of the news. So now you know when the news is going to come out for a scheduled piece of news. It's good to know the amount of impact you're looking for after the news has come out. So as I say, in my experience, a move of 50% of the ATR based on a 20-day average true range is a good piece of impact for me. So once you've had that move, then you can then place a buy stop. This is a buy example at the news origin price for 3 units of the market that you're looking to trade. I say 3 units because I like to get into a market and exit in partial amounts. So for example, if I'm buying 3 lots of euro dollar, I like to get out of 1 lot after a certain amount, move the stop up to break even, get out at the second lot after a certain amount again, move the stop up to perhaps the first target, and then get out at the third target or on the time exit. Okay, this is the graphical example of what I'm talking about. So we have the news origin point here. We get the impact here, the break from this break and retrace trading methodology. We get the break lower, at which point we can say, okay, we've had impact. Should we get back up to the news origin point, we're going to be buying 3 units of the market that we're trading. Placing a stop usually below the low of the move, the low of the day in many cases. But sometimes if that move is too far away, one might want to put the stop perhaps a little bit closer to the market. It all depends. But once you're in, you have a stop and you have targets PT1, PT2, and PT3. Now, I like to have PT1 at usually around the same level or distance as the distance between the entry price and the stop. So once we get to PT1, we've moved a distance roughly equivalent to that of the amount that we've risked on the stop loss. Okay. So as I say, as the trade goes, hopefully in your favor, and we move up from the entry price to PT1, we take a third of the position off the table, and then we move the stop to entry price. So if it comes back from PT1 to entry price, then the rest of the trade is risk-free. We've got out at the 2/3 of the long position at the entry price, and we've made money on just 1/3 of the position, but not the end of the world. Should we get to PT2, we take another third out, and then we move the stop from the entry price to PT1, and then we've locked in some more of the profits. And hopefully we get to PT3 and we finish the trade, or we get out on a time exit. So PT levels can be based on the distance between the entry price and the stop, as I say, or even that ATR measure, which I like to use. So you might say, okay, I'm looking for 50% ATR move as impact. I might use a 66% ATR amount as my stop level and use that as my PT1, 2, and 3 levels too. I also like to use time-based stops where I get out after so many bars or so many days. So as an example, on these non-farm payroll ones where you have a multi-day move, often the move goes for maybe 3 days afterwards, 4 days afterwards. So you might want to get out of a long position or a short position once you've had, say, 3 days in a trade before momentum turns, because the momentum cycle can turn very quickly. The main thing is that one should capture as much of the move as you can possibly capture with a trading stop. Okay, just to flip it around to give you the sell example. So again, just before the news comes out, you know the price of the market trading. That will be the news origin price. Wait for a significant rally, move upwards after the figure. Again, a 50% ATR move from the origin price is usually good enough, and that gives you the setup for the trade, the sell trade. Should we get back down to the sell trigger, we're looking to sell, and hopefully make money on the downside. So here's the graphical example of the sell setup. News origin price is here. We get impact to the upside, 0.5 times ATR or above. So from the news origin price. But then should we get the retrace, this is the break, this is the retrace. Should we get the retrace back to and through the news origin price, then we know that all of the buyers are trapped and we're ready for the squeeze. Sell 3 units here, put a stop usually above the high of the day, but maybe sometimes a little bit lower if that distance is particularly large. And again, go for PT 1, 2, and 3, looking to move the stop down as the trade goes in your favor. So again, PT levels can be based on the multiples of the stop size, in other words, the initial trade risk. And also ATR levels can be used for the stops and for the limits. As I say, I like to use time-based stops as well. I find a lot of people, when they do trading strategies or even trading systems, they don't tend to use time-based exits. And I think time-based exits are quite good because they can get you out, they can take away some of the uncertainty about exit. I think everyone seems to know when they should enter a trade based on maybe a technical signal, or any signal for that matter. But exiting a trade is always a bit of a hard one because if your emotions are into a trade and you've got a lot of open profits, the greed factor comes in and you're more likely to stay with a position a bit too long. So it's good to know that a trade has got a shelf life. Every trade has got a shelf life. You're not going to be married to that trade. You're going to be getting out of that trade at some point, taking your profits, moving on to the next trade. So I like to use a time-based stop for exiting on these news trap setups. So this is the summary. Just as we're kind of 10, 12 minutes away from the release of the non-farm payroll number. So the summary is that these traps, they can form at any time. When I say that, I'm talking about unscheduled pieces of news. We can have an announcement just about any time, even overnight, when you're least expecting it. The fact is, we have the scheduled pieces of news, the unscheduled pieces of news. So once the trap is formed, it's good to know the origin price of the movement. Mark it down on your charts or wherever. I think it's good as part of a daily routine. If you are a discretionary trader, is to look at the previous day's action. Ask yourself, was there any news-related movement? Did it have impact the previous day? So then you can mark it on the chart, and then for the current session, the session you're just about to go into, you know that there could be a potential news trap which can give you a trading idea or a trading strategy for the current session. In fact, even if you don't trade these news traps as a full-blown strategy, I think having that information that the market has trapped the bulls or the bears on the previous session, or even a session over the previous couple of sessions, having that piece of knowledge that the market has got a bit of a bias based on market positioning, then you can add that into your, perhaps if you trade based on indicators or price patterns. It's just another piece of information that can help you when it comes to making a trading decision. Okay, so once the news trap has been formed, they can often see follow-through action, which can last for several days or indeed several weeks, depending on the extremity of the action. Sometimes, for example, the example in cable, we've not seen that price again. That was the top of the market for a very, very long time on sterling dollar. So if you are a positional trader, a multi-week, a multi-month positional trader, a news trap, an extreme news trap such as the UK election news trap can be quite a good trigger for you to take a stab at the market if you are a sterling bear, for example, for a multi-week, multi-month view. So it's just another piece of information that you won't necessarily find on your charting packages. Okay, as I mentioned before, trading on news or just prior to big news releases such as non-farm payroll can be a little bit risky, particularly if you're a short-term trader. So it's better to let the market show its hand, in my opinion. Unless you're going to place a stop loss a long, long way away from the current market and sit through the release, I think it's good, if you are particularly a short-term trader, to wait until that news release has come and gone, so you can say, okay, I know what's happened with regards to the news. I've got myself a trading setup or a trading bias now because a trap has formed or a trap has not formed, and then you can make your trading decisions. So, being a disciplined trader, better to wait for the news release before making those decisions. In fact, one thing that happens with these major releases, just prior to the news releases, the spreads will start to widen on some of these major markets, which usually will have very tight spreads. But as you get closer and closer to the release of the number, because particularly something like non-farm payroll, which can be so erratic and differ so wildly from the market consensus, particularly now as we're in a bit of an unknown territory with regards to the unemployment rate and the number of non-farm payrolls that we're losing. The consensus and the actual can vary very wildly. So what typically happens just going into the number, as I say, is the spreads can widen quite sharply as some of the major players, the big guys in the markets, they don't want to be caught with the wrong position going into the number. So you tend to get this kind of widening of spreads. And sometimes if you have a stop in the market, let's say the market widens out to 10, 20, 30 pips wide, your stop is only 20 pips away, you're going to get taken out on noise or on a piece of random spread widening. So I'd say particularly for the short-term trader, not a good idea to be positioned in the market just prior to the number coming out. So the idea is to wait for the trap to form, and once the trap has formed, then we can make our trade with confidence. So the strategy itself, I would say, is valid on most markets. Some markets more than others. Obviously, the dollar and gold are quite good markets for non-farm payroll related news. But if you're looking at particular markets, sterling, Canada, some of the other markets, then I would say look at some of the news releases for those countries that are part of the currency pair. So if you're a cable trader, I'd say around 10:30 in Central European time, that's when a lot of the UK news releases get done. That would be a good time to look for sterling-related news traps to form. So that's pretty much the idea. Is you'll see them on the economic calendar, and as the news comes out, then you are waiting. You've got a plan. You're waiting for the market. You know how far the market should go up or down based upon the news, and once it's done that, you know where the origin price is for the trap trade. And once the market comes back to the news trap origin, then you've got yourself either a trade or a bias, which can help you with the trading for the rest of the session, or maybe even the next few sessions. So valid on news on all markets. Okay, just before we head into this number, a little bit on money management for trading. So I would say not just on news trap trading, but on trading in general, it's a very good idea to keep your risk constant as a percentage of open equity. So, for example, if you have a trading setup and you've got a good feeling about it, it's not a great idea to say, well, I'm going to bet or risk twice as much on this particular trade because I feel kind of good about this particular trade. It's a good idea to say, okay, I'm a trader, I've got a certain amount of capital, I risk 1% of my equity on every trade, or 2% of my equity on every trade, or whatever the number is that fits in with your trading plan. So you know what your risk is on every single trade. So if you get stopped out, which is going to happen from time to time, it's not going to do too much damage. That's the main thing as a trader. You should be constantly thinking about the size of your account, how much damage a particular losing trade can do to your account. think risk first and reward afterwards. Because if you think about the risk, then that will take care, with a good strategy and good risk control, over the long haul, you should be doing okay. So in terms of keeping risk under control, I say never risk more than 2% of your account on any one trade. That's a bit of an arbitrary random number, because there are people out there that like to risk larger amounts. But the key point is to keep it relative to the percentage of your risk mandate. So if your risk mandate is say a 20% maximum drawdown, you might not be wanting to risk more than 1 or 2%. But if it's more than that, then you may be allowed to risk 4%, for example. But the key point is to keep it under control. I would say that the best traders and systems, they do experience drawdowns. So that's why this risk control is very important for traders, particularly new traders, people who perhaps don't trade for a living or haven't traded for a long time, to get just to keep things under control. There will be periods where you suffer a string of losing trades, but if you stick with the system, with the plan, in this case with the news trap strategy, then you will be on the right. You should be on the right track, and to reap the benefits when the trap forms. So the main thing to remember here is to literally just to be patient and to wait for the trap to form before taking that trade. Okay, I'm just going to switch across now to the screen so we can see where we are on the markets. Okay, so here we are just prior to, we're just still heading into a couple of minutes before. We can see that euro dollar is trading at 113.33 or so. Gold is trading at 17.03 or so. So we're getting close to where the origin prices should be for this particular trading setup. Okay, now the ATR for these markets, the euro dollar average true range comes in around 82 pips. So a 41 pip move away from the origin price, that would give you half an ATR. So that's the kind of impact I'm looking for on euro dollar, a 40 pip or so move from the news origin price on or after the news release. On gold, the ATR is currently what, $23, $24 on gold. So you're looking for a $12 move or thereabouts just after or from the news origin price. So they're the kind of numbers that I'm looking for once the market has moved based upon the release of the number. So we're expecting the market consensus is a decline in 8 million jobs for the previous month. It will come out. There may be a slight delay on hitting my screen, but we will see where the impact is on euro dollar and gold. So we're just waiting for the number to come out within a minute, I would say. It should be coming out. Let's just see where we are. So 113.32, 1701 or so thereabouts, but we can go back to it. Okay, just waiting. The bells are going off. We're seeing a bit of movement, and euro dollar is starting to decline a little bit, 113.25. Gold has fallen quite sharply. So we've got a bit of impact on gold. We've gone down to 90, the day low is 93. So not massive impact just yet on gold. The origin price on gold was 1,700 and a bit. So you're looking for 88 or so on gold as impact. Okay, not a whole lot of impact yet on euro dollar. So gold has reacted quite sharply. So let's say 1688 or so. We get down 1688 or slightly below for gold. Waiting for that. So the number has come in a lot better than expected. 2.5 million rise by the looks of things. The unemployment rate is at 13.3, as opposed to a forecast of just below 20%. Okay, so these are much better numbers than expected. And yes, they've bought the dollar slightly, just testing session lows on euro dollar. Yeah, so this is the typical reaction that we should be seeing. People buying the US dollar. Gold often goes in line with the US dollar, so we're seeing the impact on gold. We haven't quite got to the breakdown level. On euro dollar, 41 pips from the origin price. So the origin price on euro dollar, 13.32. So 13.32 minus, we're looking for 41. So 13.32 minus 41, 12.91. So we're looking for 12.91 on euro dollar for impact. We're 10 pips away, and we're a couple of dollars away on gold. Getting pretty close now on euro dollar. Looks like we're seeing the impact on euro dollar, which is good. Okay, let's just go back to an hourly chart there. So there's the hourly chart of the market developing. Gold, we'll switch to an hourly chart there. So you can see the impact that we've got on both of these markets. So I would say on euro dollar in particular, yeah, euro dollar has broken through. We've now seen the impact. So now the news trap origin for euro dollar, that comes in at, let me just, that's an hourly chart. Let's just go back to the thing. Okay, 113.32. So 113.32 on euro dollar. Should we see 113.32 on euro dollar, then that will spring the trap, and that will give us the buy setup going into the session and maybe in for the next few sessions. Gold still hasn't quite got down to the impact level. The news origin price on gold is, let's switch that back across, 17.88 should be or thereabouts. Taking a bit of time there. There you go. Yeah, 1700.5 on gold. Haven't really seen the impact, the desired impact just yet. Okay, so euro dollar, it's hit a low of, looks like 25, where are we? No, 112.85, a little bit bouncy from the lows. Okay. Okay, so this is just something that that needs to be monitored over the rest of the session. Let me just flip it back. We can now go across to do some questions on the news trap strategy. Meanwhile, keeping an eyeball on euro dollar. Okay. If there are any questions, please feel free to fire them across into the chat window. Okay, so if there are no questions based on the strategy, obviously we can keep an eye on the market as we break up to the news origin point. Should we get there? We've seen a bit of a bounce on euro dollar now, 113.15. Should we get to the news origin point at 13.32, 33 or so, then that will that will spring the trap. Gold is at 91.5 or so, 92. Could be seeing a potential trap on gold. Okay, so if there are no further questions, please feel free to fire me an email, howardmarkfriend@gmail.com. If there are any further questions on the presentation, I'll be up. I'm doing a few more presentations over the next few weeks, so please check me out on the CFI website, and I look forward to seeing you there.